I want to thank everybody for joining us today. My name is Jared Sebesta. I'm going to be your host and moderator for this webinar that we are calling Sunsetting Federal Tax Laws, What Farmers and Business Owners Need to Know Now. If you are unfamiliar with our firm, we are Taatjes Financial Group. We are based in Willmar, Minnesota. We're an independent retirement planning firm. Our goal is to help retirees and pre-retirees steward their time, their talent, and their treasure. We do this by building purposeful retirement plans. And this whole thing is really even just baked into our logo as well. Like our logo has 3 T's in it. If you check out our logo, you go to taatjesfinancial.com, you'll see our logo on there. The T's stand for time, talent, and treasure. Many people think that it stands for Taatjes. It actually does not. It stands for time, talent, and treasure. We encourage you to go to our website and look more about that and read more about that. Like I mentioned earlier, we are going to be utilizing the chat feature a lot today. If you have questions, comments, concerns throughout the call, please put your questions and concerns in the chat feature. We will try to answer those throughout, but we are going to budget time at the end for question and answer. So make sure that you get your questions answered here today. I am going to try to put up a poll here today. I want to get a little lay of the land. Who do we have in the room here? Feel free to just to take a second and choose which option fits you best. Who do we have in the room? I'm a farmer, I'm a business owner, or I'm neither, but I'm just here to learn more. You just take a moment, check that out. Getting several people already responding. Many of you. Looks like we have about 17 farmers on the call, which is great. About 6 business owners and about 6 people that are neither but want to learn more. That's pretty much what I expected. But this is great. Obviously, farmers, you could consider yourselves business owners, but regardless, these tax changes are going to affect both of you. And a lot of people will be affected kind of indirectly, or maybe family members affected by this. So again, we've got a nice variety of people here, but mostly farmers and business owners, which is phenomenal. That's great. All right. I do want to get started by introducing our panel here today. First of all, financial advisor Ben Taatjes. He is the owner and CEO of Taatjes Financial Group. Ben, if you would just give us a little bit of a background as to who you are and how your expertise plays into our topic today. Introduce Ben.
Yeah. Hey, thanks, Jared. Excited to be here, everybody, and excited to have Andrew on the call and Kendra as well. And yeah, I've been an advisor now for over 20 years. It's crazy how long that has been. It went back by fast, but throughout my time, I've seen a ton of different changes in tax code. It seems like every few years there's some new IRS changes, and we always seem to be waiting on what could change and what might change. And I'm so excited to have Andrew here today to kind of give us an update on that. And I think when it comes to, like Jared said, with our firm, when you see the 3 T's, time, talent, treasure, treasure is the one that we seem to talk about the most, right? And how we steward that. When I look at our clients, and I look at what's most important to them, it's preparing the next steward and making sure that when we have the estate tax discussion, we have these discussions, it's all about making sure they don't leave things a mess for their family someday. And I'm excited to have Andrew here to kind of update us on, steps we can take and both the upcoming tax changes. So yeah, excited to have him here. And my job sometimes when we talk with attorneys is to, I'm not gonna say dumb it down, but I oftentimes love to just educate and say, okay, what did you mean by that? So you may hear me from time to time pipe in today on just explain it, because I get to deal with many CPAs, many attorneys. They all have a different way of explaining things, but oftentimes we end up being the quarterback that puts it together and continues to educate our clients as changes happen, because we get to see a lot of our clients more often throughout the year. So I'm excited for the call, and yeah, thanks for joining us.
Yeah, you bet. Andy Zenk, he is an attorney with Zenk Law. You are based in Glenwood, but also you have offices in Montevideo and Willmar. Again, huge thanks for being here, Andy. You're going to be doing a lot of the talking here today, but give people a little background on Zenk Law and how your expertise is coming into play today, which is going to be in a huge way.
Absolutely. Well, first of all, thank you so much, Ben, Kendra, Jared, for having me as part of this panel today. I'm very grateful to be here and to share things with you today. So Andy Zenk is my name, like you said, attorney in Glenwood, Minnesota. We specialize here in estate planning, business planning, business succession and retirement transition planning. And my background, my history, I did prior to Zenk Law's official opening a few years ago. I'd done a lot of consulting with farmers, ranchers, business owners on transition planning, estate planning, business planning, all of those different things. So my area professionally is in these areas. And with that, the topic we're going to talk about today, tax planning, tax issues with the Tax Cut and Jobs Act and what's on the plate. So like you said, main office in Glenwood. We do have available appointments in Wilmer and in Montevideo as well. And looking forward to being here today.
What Andy didn't say is that we're both Montevideo alumni, so we go back
Right.
a long time. So it's been fun on a side note to reconnect with you, Andy, on this topic and just in life in general.
Feelings mutual, man.
Yeah, man. Let's just talk about why we're here. Let's set up as to why we're here. Let's get into the nuts and bolts of some of these tax changes. Andy, why don't you get us going on some of these changes, especially at the federal level, and then we'll work down to the state level. Then we'll talk strategy, but just kind of set us up as to why we're here today.
Sure. Thanks, Jared. So what we're talking about today, everybody, is what's called it's our current federal tax code, and it's called it was done in 2017. It's called the Tax Cuts and Jobs Act. And what that did is it made for some pretty substantial changes to income tax, business, corporate tax, charitable giving, and what our main topic is today, estate and gift tax, okay? And what that means is when we talk about estate tax and gift tax, from a federal level, when a person dies, they can shelter a certain amount of assets from an estate tax, okay? So it's called an exemption or an exclusion. So think of it as a bucket, okay? You can fill this bucket up with assets. And that once that bucket is full, anything in addition to that spills out, and that's what's subject to tax. So prior to the 2017 Tax Cuts and Jobs Act, that exemption, that number was 5 million adjusted for inflation. So back then it was about 5,490,000. This law then more than doubled it, okay? It said per person we can have, it was at that time when they did it, 11 million and some 11 million, I don't recall the exact amount, about 11.2 million per person. But today, folks, it's 13,610,000 per person. So we went from 5.5 million pre-Tax Cuts and Jobs Act to now we're in 2024, if a person dies from a federal estate tax, 13,610,000 that you can shelter before there's any estate tax owed. Now, that's per person. Spouses can combine their amounts using this legal matter called portability. What that means is husband and wife, if now death has to occur, remember, but we have a $27,220,000 exemption under the current rates. Now that's a really high exemption, right? Most people fall under that. This rule and why we're talking about it, and Jared said it, and it's been in the information, it's set to sunset. Another word for that is expire. Written in the law, 1/1/2026, this law, many of the changes under this law, not all of them, but the ones we're talking about today, specifically the estate and gifting, they're set to expire. They're set to revert back to the pre-Tax Cuts and Jobs Act. So we're going to go from about $30 million that a couple can shelter back down to about 13 million. Okay, 13 to 14 million, if that's what happens. And when I say if that's what happens, the law says that. That is what is written in. However, it's possible that Congress, through legislative action, can extend this bill or they can change this bill. We all know estate planning, estate taxes especially, can be a pretty politically motivated bill. So to be determined on that, but as it sits now, there's nothing pending. There's nothing that's out there that's looking to change this, but we're going to be in for quite a interesting next couple of years. So, but the point is, we have it going from a very high exemption to a relatively low, cutting it in half. But why does it matter? If you're over the exemption, the federal estate tax on any dollar amount over is 40%. Okay, so if you're $1 million over, That's a $400,000 tax. Why are we talking with our farmers and our business owners? We look at farm, we think of farmland in many cases, right? Farmland is that's equity. That is not dollars sitting in your bank. That is a critical key component to many agricultural operations. That has a very high value. That high value is included in your taxable estate. Okay, so what is a taxable estate? Taxable estate is the government's determination as to how much a person is worth when they pass away. Okay, so what a taxable estate is it's your assets less your liabilities, and then there's some additional deductions at death. But the big one is your assets less your liabilities, your balance sheet. Now, what's different from most balance sheets that I see when I have producers come in and they give me their balance sheet that they give their lender, for example, we might have some pretty conservative numbers. Our land's valued conservatively. That's fine. There's that. I get that completely. The point, though, is when a person dies, the value of that land, for example, is appraised value. So one of the things that has to be done is we have an appraisal done. And this is a good time to talk about it too, because we're also in a scenario, in a reality where land values have been increasing substantially. So we have a very highly valuable equity positioned asset in our taxable estate. So when we're talking about millions of dollars of exemption, we're also talking in many cases about $1 million worth of land, $1 million worth of machinery and equipment, millions of dollars worth of key capital assets to keep these businesses going that we can't liquidate. We don't have cash that will pay those taxes. So it's such an important pressing issue. Switch gears a little bit to the gifting side of the estate planning piece too. So estate taxes from a federal standpoint, they're unified. They're tied with the ability of one person to make a gift. Okay, so how does gifting work? Gifting has two parts. The first one is what we call our annual gifting allowance. Okay, our annual gifting allowance. Each year, one person can gift to another person $18,000. We call this our freebie, okay? What that means is there's no reporting requirements. There isn't anything that gets deducted or so forth from our estate tax exemption. Now, married couples, two people, can give one person $36,000, $18,000 times two. They can add that person's spouse to get another $36,000. If a married couple has 4 kids, they can give each of those kids $36,000. So there can be we can quickly compound this and use the value of this annual gifting allowance to our advantage. And that can be a good strategy. Why? Is that's not a reported gift. Okay. Now it might have to be reported on your income tax return, depending on the type of gift you do it. But from a gift tax standpoint, it's not anything that needs to be reported. That takes us to the second level of gifting. Okay, if a person exceeds that annual $18,000 to another person in any given year, now we have to tap into what's called our lifetime gift exclusion, otherwise known as our unified credit. Okay, now that amount is for 2024, $13,610,000. Now that number might sound familiar. I said that a couple minutes ago. $13,610,000 is our estate tax credit too. These two numbers are linked, okay? So if you tap into that lifetime gift, we go over the $18,000 per person per year, we have to file a gift tax return with the federal government. And that directly reduces how much you can shelter from the federal estate tax, okay? So just to give some nuts and bolts, quick example. Let's say a person decides to give $1 million worth of assets. Okay, let's say $1,018,000, just for easy math in my head. One person gives to another person $1,018,000 worth of assets. We go through the first level of the gifting, right? That first $18,000 that comes off as their annual gift. That $1 million excess, now that comes off of our $13,610,000. So what that means is there's zero gift tax because we're well under the exemption. But when the person dies, we're essentially going down to that $12,610,000. We have to reduce it. They're tied together. So in other words, we can't gift away $13 million and also shelter $13 million at death. It's one or the other, or a combination of both.
Hmm. Ben, why don't you jump in here? What Andy threw a lot at us, a lot of information. What are some things that are sticking out to you from kind of a retirement planning aspect?
Well, he talked a lot about the sunsetting and how that impacts the estate tax. I know that's why what we're here for today, but keep in mind the income taxes will change too. And that's a key thing that everybody in this call needs to remember is we have a known period of time, right? We have this period of time where we know what the unified credit is. We know what our income tax brackets are. Whether or not they change or not in 2 years, and if it sunsets and it goes back to where they were, or if it changes and there's some meeting, it's somewhere in the middle. Either way, we know today where we're at. So that's what I was thinking about is if we understand the certainty of today's tax brackets and estate tax rules, we can work with that. And I'm thinking Andrew would agree with me that chances are things it will be the same or worse. In my mind, we look at our government today and the extreme spending that's happened. Remember a few years ago, they had something called the Deficit Reduction Act. I don't know if you remember that one. Of course, the exact opposite happens every time the government has an act. There's a huger deficit that came out of it. But the reality was they were trying to take care of overspending and reduce our deficit. I don't know what they're going to call this one, but my chances are we're going to see more restrictive estate tax code and income taxes will be going up. So a key to me is let's understand what I can do today until the potential sunset. That we know we've got this 2-year window. Let's make the most of it. And I think that's what Andrew's trying to say is, there's a lot of numbers he's throwing around, which very, very important. The one that sticks out to me is that's a ton. I mean, 27 plus $1 million that you can, be free from estate tax today is going to change dramatically in just a short period of time. So we have to make the most of the window that we've been given. In our world, it looks like Roth conversions. If we're speaking estate taxes, there's other tools and techniques that Andrew and other attorneys will use. But the concept is this is I've been doing this 20 years. I've never seen this size of income tax brackets like we have today, or estate tax brackets. So it's a very, very good time to be doing some planning.
Mm-hmm. Andy, what are your thoughts on that?
Yeah, couldn't agree more on many of the comments that you made, especially the one where I think we can all agree that the likelihood of things getting better from a tax standpoint, given all of our deficit pressures and spending, very, very unlikely. So that word, I really clung to with Ben's words, that the opportunity now, I think is really important, and I'm glad you brought that up. So what are some opportunities? Okay, so speaking from the farm or the business owner, that we have these highly valued assets that need to stay in the operation, need to stay in the family. What are some options? Frankly, one of the big ones that you look at is gifting. Okay, so we've talked about gifting, we've introduced that. How do we do it? Depends on the type of asset. Okay, so for example, you can gift land. For example, you can gift land. You can say, we can deed land over a term of years. That gets a little bit messy. That means we're doing undivided interest. That means we're doing things like that. That will get cumbersome there. With that, we might couple another tool that helps us power up the gift or reinforce the value of those assets. And we might, what I mean by that is we use an entity such as a limited liability, limited partnership. Now that's a mouthful, so we're going to call it a triple LP. And it's a limited partnership, so it's a type of entity where mom and dad, in this case, the landowners, okay, they own the land. And if their goal is to gift assets to the next generation, what a triple LP does is it has two types of owners. It has the general owner or the general partner. And what they are is they're the they're the responsible party. They're the leader. They're the ones with all the control. Okay. We also have a limited partner. The limited partner is the opposite. They don't have any control. They have an equity position. They're along for the ride. Okay. Now, how this gets split up is mom and dad own this land 50-50. Okay. Mom and dad then transfer the land to that LLLP. And in return, mom gets a 1% general partnership share. Dad gets a 1% general partnership share. Now that's a sliver of ownership, but that's all you need because that's the class of ownership that has all the control. They also each get a 49% limited partnership share. Okay. Now what we've done here is we've created a shell, or we've created a tool that will help efficiently be able to gift the asset that gets put into this entity. Okay. So I keep going back to land. Instead of deeding specific acres over, now mom and dad can gift limited partnership interests over. Now they give limited partnership interest as opposed to general partnership interest because they can retain the control for the rest of their lives. So that's a tool, a strategy to become efficient in your gifting, to be able to gift shares as opposed to actual deeded acres or business assets, etc. But do so in a way that not only do we have an efficient mechanism, we also have a way that mom and dad can keep control. Very important with gifting. And I want to talk about that, but there's one other element to this. It checks another box, especially when we have farming and non-farming children. And again, I go to the farm side of this because we use these a lot for land, but it's not exclusive for that. If we have a scenario, we have one or more children that are involved in the business, and then we have other children who aren't involved in the business, this can be a good estate planning tool to help figure out how to fairly distribute the assets, but keep control with those involved in the business. Okay. So when mom and dad pass away, those 1% general partnership interests, they can go to those that are continuing in the operation, those continued business owners. The equity, the limited partnership share interest, those can go to the non-farming heirs, those heirs that aren't part of the operation. Great way to keep that control and also keep some combined ownership so that all of the kids can benefit, but in a way that business can continue to go forward. Now, another good thing about these triple LPs. Now, before I say that, these aren't the silver bullet. There's always a but for everything, and we'll talk about that. But another good thing about it and why we look at these as a strategy is there are what we call minority and marketability share discounts associated with closely held entities, like a limited liability, limited partnership is. Okay. So let's say that land is worth $10,000 an acre. And I'm just picking a number out of the air, but I know in our listening area, there's places that is true. If mom and dad own that land outright, they have it as mom and dad individually owning it. We haven't done a triple LP or anything like that. When they die, or when we add that up in their taxable estate, it's whatever the fair market value is. Okay, so it's the 10,000 per acre. Putting it into a closely held entity such as a limited liability, limited partnership, this triple LP we're talking about, we have the option, the availability of what are called marketability discounts and minority share discounts. The bigger one is what's called a marketability discount. Okay, what this means is mom and dad put it into this entity and they agree to say, we're restricting who can be an owner. Okay, so it's not a readily transferable asset anymore, like it was when it was land. We're also, depending on how much they decide to gift, if they get down to a minority interest in this entity, we can take an additional discount from that fair market value. Now, what that discount is really dependent on the circumstances. But if you look at a 20 to 25% discount, that's something that would be, I'd say in today's reality, something you could take. So what does that mean with our $10,000 land? the same $10,000 land inside this LLLP from a taxable estate standpoint, we're now discounted at 25%, so we're at 7,500 per acre. You take that over several acres, that's some significant estate tax savings. So that's one strategy, and I know that's a lot of information quickly, but that's one strategy that we use not only to help the gifting process from an efficiency standpoint, but to really beef up our ability to gifting more assets for the same value.
Ben, what are your thoughts so far?
Well, I think, the discounting, I was interested to see what kind of percentage he was willing to throw out there on the discounting due to control and marketability. Different attorneys say different things, but yeah, we've heard back in the day it was like 40%, and then it was 30, it was 30, 25. It all depends, right? If you can substantiate it, if what the IRS, if they audit, what that looks like. But I think what he's talking about there, it does allow you to get more bang for your buck on your wealth transfer. But I love the idea about having general partners and that piece being transferred to the farming heirs, and non-farming heirs being somewhat treated with some level of asset as well someday. You'll never find something. It's a whole nother webinar on what's fair, what's equal. We could sit here and talk about that. Maybe we should sometime, Andrew. But at the end of the day, what I think about when we start having these discussions with our clients is we're talking estate planning, we're talking wealth transfer, right? The reality of it is you are going to die, right? That we know. We know that we can't take anything with us, right? We know that we'll likely die at a time I don't expect. So we don't know if it's this year, next year, 5 years from now. Someone else is going to get all our stuff. And the only time that I can decide who gets the stuff that I've had and that I've been stewarding now is before I die. So a key component to all of what we're talking about here is taking control of the next couple of years, hopefully even the next couple of months, to make meaningful changes in your estate plan so you can take advantage of the changes that before they happen, right? Take advantage of what we have today, but also get some decisions made, get some control there that you can decide what happens with your stuff after you're gone. So I think it's good. I think the piece that I would be asking if I'm a client, and maybe that's where you can go, Andrew, is from an income tax standpoint, what happens and how complex is this stuff? When you talk about the people start saying the limited partnerships and all these other things that attorneys talk about, how complex are they? How costful are they? How much do they cost? And then what does it do to my income tax situation?
Okay, great. Thank you. So how complex are they? You're going to get the classic attorney answer. It depends, right? Hate to say that, but every case is different. Having said that, to give you some good answers, these have their place in many operations. Here's what I will tell you. For certain, they're a separate set of books. Okay, so these discounts we talk about for marketability, lack of control, minority shares, they've been on the chopping block with the government. They're not something that they like, okay, but they continue to routinely be available, different levels, of course. But if we don't treat that entity as a separate entity, meaning having a separate set of books, having a separate tax return, that's another requirement that we have, okay? So now if mom and dad have had a 1040, now we're also going to have a form 1065 because the land is owned by a separate partnership. We also have rental agreements. Mom and dad or whoever's farming that land, now they are renting it from the triple LP. So there's income coming out of the farm. And if that farm is a Schedule F farm, well, that could be a tax benefit because it's a deduction coming out of that farm. Now, that income, it's not a big tax benefit because it gets picked up on the 1065, the general partnership form, okay? That goes back to the parents' income on that side. Also, there's a need for keeping what are called business entity formalities. So when we set these up for people, we need to establish them with the state of Minnesota. There are reporting requirements with the state of Minnesota Secretary of State. There are reporting requirements with the Minnesota Department of Agriculture. In the works, there are reporting requirements with the federal government for this and the different types of entities. There are what we call governing documents. So a triple LP has a partnership agreement. And then that partnership agreement, think of that as kind of the rules for the entity, how everybody's going to be operating. Incredibly important piece to this, because within it, we build what's called a buy-sell agreement that says who can be an owner, how can the shares be transferred, how do they value them, to make sure that as people die, as people, as the next generation come in, there can be some control there. Fees are very, very across the board. I will say that when I sit down with clients, we have this initial consultation where there's a fee for, but by the end of that meeting, usually we can talk very specifically about what they're generally going to have as a part of their specific deal there. So I'd like to leave that at that, Ben, if possible. There's also a question I just happened to notice on the chat, Jared, so I'm going to jump over on that one because it's a perfect.
I was about to say too.
Yeah, it's a perfect segue. We talk about gifting and how gifting is a great tool, and it absolutely is, folks. And I totally agree with Ben. It's a great tool if it works for you. But here's some of the additional nuts and bolts to it. And the question by one of the attendees is, can you speak to how cost basis is affected? And what that means is our basis in an asset really is what we paid for. Okay, now there's some adjustments and so forth, but just for our understanding here, our basis, that's our cost basis. Okay, what we sell that asset for, if we decide to sell it, we pay tax on the difference between our basis and what we sell it for. Okay, now we're not selling it in this case, we're gifting it. When you gift an asset, your basis gets transferred to the recipient. Okay, so let me give you an example. We go back to that $10,000 per acre land. Let's say we put, whether you put it in a triple LP and gift the triple LP, or you just gift that land over. What we look at is what are the donors or the givers, what did they originally attain that land for? And usually what happens there is it's a pretty low basis. Bought it years ago, inherited it years ago. Let's say it's $1,000 per acre. That's the basis in that land. And they gift that land that's worth $10,000 per acre, their basis transfers, it carries over. So the recipient's basis is now $1,000 per acre. Now let's compare that if mom and dad or the owners keep that asset until death. If they keep the asset until death, under current laws, they get what's called a step up in basis. So the people inheriting it won't have that $1,000 per acre basis anymore. That gets stepped up to the current fair market value as a date of death, which in our example is $10,000. So I'm really glad the question was asked, because it's a really important awareness, understanding to have with gifting.
Yeah, I love the question too, Andrew, and it came from one of our advisors. So they're always thinking, what's the tax implications, everything we do? I will say, when it comes down to land specifically, I don't meet a lot of farmers that are real excited about selling their land or having their children sell their land. In fact, many of them see that as, hey, it's not something I want them to sell anyway. So yes, it is something to be aware of, as you said, but many times the potential estate tax savings, if that's certainly why we're doing this, far outweighs the chance that there could be income tax paid someday if the kids sell it, right?
Good point. Very good point. I've had plenty of farmers say, well, that's a good thing because it's just going to be another deterrent not to sell it. So, and it all goes kind of back to that. You know, everybody's different there. So
yeah, and it's certainly if you're able to not have to sell land. I mean, if you're talking about a very large estate, potentially doing some of this means nobody has to sell land someday to come up with taxes owed, right? That's a reality in today's farm world, is that if you're not planning properly, potentially you end up having to create liquidity. And for many farm families, that is not something they want to be going through or can go through when mom or dad passes, because the farm needs the land to farm and they need all the equipment. It's hard to come up with liquidity to pay a state tax. So
Right.
usually a sale of land is the last thing we want to look at. But I love the question.
I want to jump in.
It,
I want to go ahead. I want to jump in here just really quick. I'm sorry, Andy. I'm so sorry to interrupt. Just a couple of questions here in the chat that I want to get to, and maybe we can just kind of rapid fire these quickly without maybe going down too much of a rabbit trail. But Randy asked, can you have a triple LP inside of a revocable trust?
You absolutely can. Not only can, that's an excellent strategy. So think of the revocable living trust as kind of the foundational estate planning document. And the revocable living trust's primary reason to exist is to have a plan that says, here's how my assets are transferred at my death, which would include a triple LP. And number two, avoid probate. So another very important piece for many people to help minimize the hoops and the hassles at death, which probate can create. So you absolutely can.
Michael said Andrew's using farming examples. Do these same concepts apply to other businesses?
Thank you for that. Yes, they do. They do to certain extents. Now, other businesses, the difference with when we talk about farming examples, and I keep going back to dirt, land, it comes into how it's taxed. Okay, so bare ground is taxed as a capital gain. Okay, the same rules apply to businesses. The businesses, however, they might have different types of tax, right? For example, if we transfer an ongoing business that is an LLC, or they're taxed as a partnership, or whatever the case may be, and we start gifting those, or you sell them at a discount or something to that extent, we have a much different tax outlook as a result of that. And one example is what's called depreciation recapture. So for example, if we sell as part of or transfer at a discount, not gift, gifting's a whole other deal, but we're kind of getting another thing. If you transfer at a discount, but still sell it, you're going to have what's called depreciation recapture that's a whole nother income tax issue than say capital gains tax. It's essentially taxed as ordinary income. So absolutely the same concepts apply, but it's very important to meet with your team of professionals to know specifically what's going to affect me with my business, with my operation.
Eric just asked a question in the chat. Is discounted land in a triple LP also then discounted assets on a balance sheet, which have an impact on lending situations?
That's a great question too. What I would answer that with is it's very possible that could be the case. And that's why Ben talked about the quarterback mentality. And what that to me suggests is the team. One of the most important things I want to convey here and to all my clients is we need to have a team approach. The legal side, the tax side, the financial side, the lending side, to make sure that what we're doing fits all those, and we're not stepping in something, i.e., does this have an impact on lending situations? So we talk to that person's lender, make sure that what we're doing here is still something that's going to fit their strategies in that respect.
I like it. I want to get the questions here and start to land this plane in about 5 minutes. Again, if you got more questions, please put them in the chat, everybody. But one thing we haven't touched on, and not everybody's from Minnesota, but Andy, can you briefly kind of talk about the changes and non-changes at the state level?
Thank you, Jared. So when we talk strategy, Minnesota is one of a handful of states in our country that has its own separate state estate tax. Okay, so when we talked about that exemption, the federal exemption, we're at 27,220,000 per couple right now. Minnesota is decoupled from that, meaning we start earlier. Our exemption per person is 3 million per person. Okay, so you think 13.6 million federal, 3 million state. That's a big disparity there, right? Now couples, as long as you have the right estate plan, we can get that to 6. Okay, and then if we have the right either farmland or small business assets, you can get an additional 2 million under certain circumstances. But we still have the issue of that large disparity. And this goes to what Ben was talking about earlier, is an opportunity that we know now. There's a lot of people that are under the federal exemption. So they're under that 27 million, but they're over Minnesota exemption. Okay, so we're somewhere in that 12 to 14 million dollar range. The opportunity we have now is you can make a gift that would get you under the 10 million, therefore not paying any Minnesota estate tax, and also not paying any federal gift tax, because the ability to be able to do that, we have enough credit. We have 27 million to be able to do that. In less than 2 years, that's going to go down to 13.6 million. So that goes to what Ben was saying earlier. That opportunity will no longer be there. Now, what they end up doing, if they extend it, that type of thing, we can't control, but we know now this is an opportunity to pass wealth.
Mm-hmm.
So Minnesota, that's a very important element to understand here. And there's one other thing I want to talk about that. Minnesota does not have a gift tax, okay? So unlike the feds where we have to reduce how much we shelter at death, if we make that $1 million gift I talked about earlier, how we have to go from 13 million down to 12 million, Minnesota does not require that as long as we don't die within 3 years of making the gift. Okay, so there's a 3-year clawback rule, but as long as you can meet that 3 years, you still have that entire $10 million, assuming that's what the exemption is at your death.
Got one more question in the chat. If you gift 1 million now and the exemption changes, do you still have the 13.6 million because you did it now, or is it whatever it is at the time of death?
Great question. You are, so it's the time of death. However, the IRS has already conceded to say that if you made a significant gift now, let's say somebody they were worth, with the 27 million that you could gift, they made a gift of $12 million, okay? And then that number later on goes down to 13.6 million that you can shelter total. So essentially we're over the amount that you could have gifted. We don't get any more. You don't get another 13.6, but they can't retroactively tax you on that. They've already talked about that and conceded that that would be the case. So I think that's what that question's getting at. If the exemption changes, you change along with that exemption and you don't get more because you did it now, but you aren't going to be retroactively taxed later on.
Ben, chime in here.
Well,
what do you
I just
think?
wanted to add on how important that opportunity, Andrew just talked about the state of Minnesota, folks. Those are all the numbers that we've been throwing around. That's probably the most significant one. I see most of these names are Minnesota people. Some of you here, 27 million, you're like, oh, it's not going to matter. This matters in Minnesota because, again, we do not, as Andrew said, have a gift tax return that you have to file. There's no gift tax out there. So I think for Minnesotans, this is a really key time. And I, like most professionals, don't see Minnesota getting any easier on our tax situation, only taxing us with our income more and estate more. So I think it's a great opportunity for those people in that window for sure. And as we throw out these numbers, what I'm thinking is a lot of your heads probably spinning is, what does this mean for me? It all starts with an analysis of what you have, right? And figuring out everybody's situation is so different on this call. We're just trying to give you a few ideas today, but really you all should have a review, look through your individual situation.
Andy, anything else here? I want to start to, again, land this plane here in the next, minute or two and give people some options on next steps that they can take. Any other strategies or things that
Right.
they can do or think about or consider?
I will just say, instead of, the only thing that we would talk about is gifting does require that you can afford to make the gift, right? So one just extra tool that we've used is, instead of gifting the entire asset, use these gifting abilities to perhaps sell at a discount. Okay, so sell the business asset at a discount. If the business asset's worth $500,000 and you don't need $500,000 and you want your kid to have it, but you need some, you sell it for $200,000. You can do a partial sale, partial gift as well. Now, that's just introducing that in there's a lot more to talk about that, but I wanted to have them be aware of that too. And then just to land the plane, we've thrown a lot of numbers out. I've thrown a lot of numbers out, and I appreciate everybody hearing that. It is kind of the nature of the beast with this subject. There's just taxes are numbers driven, but it's get that analysis for you, just like Ben had said. How does this apply to you? You need to talk with your professionals, your team, to know. It's very unique, and not only what you can do, but how you do it needs to be done on a case-by-case basis. And that's what I can't stress enough. There's no one way to do any of this. And hopefully today you got more of an awareness, and that's my goal. So
yeah. Oh, you presented a ton of information at us, and I sure do appreciate that. There's a lot to consider. It seems like a lot of time that you have to prepare for this, but 2 years will go by pretty fast. And as you said, Andy, there's a lot of nuances and a lot of different strategies that people can take. So I want to give people just some options to think about. There's a URL up on the screen right now. I would love for you to go and check that out. And by the way, as we're talking here, if you have any last minute questions or comments or concerns, please put those in the chat, because we'll have a few more minutes here before we wrap up at the top of the hour to put those in there. So last minute comments, questions, and concerns, please put those in the chat. But if you have a moment, go to this URL, taatjesfinancial.com/next steps. It's actually /next dash steps. When you go there, you're going to see a page like this. And again, if you don't do anything on this, again, not everybody, most people on this call are farmers or business owners, and also live probably in the Minnesota area. So this is going to be affecting a lot of people. So the option to do nothing is not a great option. So we want to get you started on trying to get you the help and the information that you need to figure this thing out, because this will come up faster than what you think. There's 3 options on this page. And again, it's on taatjesfinancial.com/next steps. You can do a free download. You click on free download. Andy actually put together like a 4-page white paper. So all the numbers that he talked about, including the federal and state level, he broke down on a 3-page or 4-page white paper. It is very well laid out. There's tons of information on there. If you want to look at the numbers and something you can physically see and hold, I encourage you to go and click on that download. No name or email. It's just click on it and download. That comes right from Andy and his office. If you want to chat with somebody, Kendra Peterson is on this call. She's one of our financial advisors. She's fully licensed, and she knows a lot about how this is going to affect people. So if you just want to do just a really quick 15-minute assessment, just to hop on the phone with Kendra and just kind of talk about your situation and ask any specific questions that pertain to you, and maybe she can give you, not maybe, she will give you some areas of your asset situation that may be negatively affected by this tax law change. Hop on a call with her. We're going to start getting busy with taxes here pretty soon, but we blocked off tomorrow through Wednesday of next week with these little 15-minute increments on her schedule. If you want to get right on her schedule and do just a quick 15-minute assessment with Kendra, click on that middle link.
Yeah,
if you want to kind of go ahead, Ben.
1 second before you move on to request a meeting. One of the things that's nice about that 15-minute call with Kendra is she cannot give legal advice, like I cannot give legal advice. We're financial advisors, but what we can do is gather a ton of information and summarize information, so we know if this is something that you should be concerned with these changes, and then get you in contact with either your attorney. Maybe you have somebody you work with already, maybe you don't, and we can introduce you to Andrew and get you into the next step, which would be another meeting. But again, one thing Kendra is exceptionally good at, I know, because she's been one of my direct assistants for the last 5 years, is getting stuff done, following through. Very tenacious in that. So if you want to make sure things happen here, start with that 15-minute call. It costs you nothing, and we'll gather the information and make sure that an actual meeting would be right for you.
Yeah, that's a great point. And if you want to take the full next level and actually come in for a meeting, all you got to do is click on that 3rd button, and that will take you right to our request a meeting form. And that's where you can come in and meet with one of our advisors and really do like a full review and assessment. And Ben, you kind of alluded to it already, but just talk about the relationship between us and other professionals like a CPA or a guy like Andy who is expert in law? How do we fit that equation with people and their lives?
Yeah, we're certainly not estate tax attorneys or experts. That's not our job. Our job is to make sure that we quarterback the right people on your team and help you continue to follow through on tasks to make sure that the 2 years doesn't disappear that we have in front of us. So you might be on this call today and think, well, Andrew seems like a nice guy. He seems to know what he's doing, but I have my attorney. I'm happy. That's okay. Andrew understands that. He knows that everybody on this call is not going to become his client. But if you're our client, or even if you're not, you just want more information, you have an attorney, start there. We will help you organize in a way that when you do sit down in front of an attorney, Andrew or your own, you will be able to ask the right questions and be prepared, save yourself time and money in those meetings. And that's really our role, is to make sure when we get to meet with clients many times, we get to see so many different scenarios. Over 20 years, I've seen a ton of different things, and we're able to help summarize for you and give you the proper questions to ask. And that's really our role in really the whole estate tax planning discussion.
Yep. I love it. If you have more questions, have more information, you didn't get what you needed, you want to get kind of that next level of value and service, again, please go to taatjesfinancial.com/next-steps. There's a link there in the chat. Kendra put that in there as well. So just click on that link and make sure that you go check that out. We've got about 8 minutes left here. I'm looking at the chat. If you have any last minute questions, if you have any last minute concerns, please put those in there. But I just want to say this has been really beneficial, man. We've thrown a lot of stuff out there. I think, again, we've had 50 people on this call hang on the entire hour. So clearly there's a need and a desire to have this type of information that's going to affect a lot of people. Give us some last minute thoughts. Ben or Andrew, jump on in.
Well, I tell you, that call to action, whatever it is for you, I would highly encourage you to continue doing that and really using that quarterback mentality and helping them organize things for you, whether it's with your attorney, your tax professional. I mean, the value with that, I think, is just phenomenal. And don't wait. It's so easy to get energized with hearing these things and like, oh, these taxes, we got to handle them. But then as soon as, we go on to the next thing, before you know it, 2 years has gone by and boom, we've lost an opportunity. So it's very important to take advantage of that, and you got the right people in front of you. So
yeah, Ben, jump on in and just talk about that for a second. Like, again, this is not coming up to the end of next year, but as I've been in this business helping you for a decade, it just seems like when you wait, you're going to hurt yourself in the long run instead of getting on it and start getting out ahead of it.
Well, a decision to do nothing is a decision. So I think that's something that a lot of people do with this topic, because it involves death, right? It involves, as I said earlier, the known things in life are death and taxes. And certainly we know someday we will pass away. And just kind of letting it out there, knowing that maybe you have an estate tax issue, maybe you don't, maybe I'll let my kids deal with it someday. I mean, that is a decision you're making. So I would make the decision that says, I'm going to take control of this now, especially in this window, because, when it comes to wealth transfer and estate tax planning, doing nothing I've never seen it be the right answer, because either you leave your family without the tools they need to take care of things, and they end up doing the work that you should have done as a good steward to prepare them. That certainly can happen. Or you end up paying more tax than you needed to because you didn't take the proper steps in order to minimize the tax burden at death. So I think it comes down to being proactive as a steward and making changes today while you still can. So hopefully y'all take that as not a sales pitch for us. We just love helping clients live better lives. That's our job. And I know that These are not easy discussions to have when it comes to estate taxes because nobody likes to think about the end. But it's coming. There's a time when you will not be here to direct your assets. So you need to plan now. And if you do nothing, there's a chance that, again, the government takes a share of that you don't want them to have.
Yeah, that's a great point. Again, if you want more information on Andy Zenk and his practice, his URL is zenk-law.com. I've got the URL right in the chat feature. You want more information on us, taatjesfinancial.com. And like I said, if you want to make the next steps, either download the white paper, sign up for a quick 15-minute assessment call with Kendra Peterson, or request a meeting where we can really help you quarterback the situation. Again, go to taatjesfinancial.com/next-steps. You can find out all the links right there. I do not see any more questions in the chat. I will assume everything is squared away and your questions are answered. Again, if you need more information, please take us up on one of those offers that we have. Ben, thank you so much. Andy, thank you so much. Great stuff today, and taking time out of your schedule to join us on this webinar today.
Well, thank you for having me. I really appreciate the opportunity.
Appreciate everybody joining us. Thank you so much for your time here today. We're going to get you off the call 3 minutes early. Have a wonderful day, and we'll see everybody next time.